90% of the investors underperforming the market just because they are not unlucky, they were not know these five simple rules. And studies from JP Morgan says that average investors is getting the return just the half of the index return. Let me break down the five simple rules. First rule, timing the market and time in the market. Think that if we predict the crash, we can make millions and crores. But it is wrong. Let me say you why. The JP Morgan study shows that if we miss just 10 days, 10 best days returns, we would end up in just 50% of the returns were being reduced, which says you should be investing consistently without timing the market. But timing the market, why it's worse? And let me say the key takeaway. When the fear is peaked, the money start to flow. Then the flow creates an best day after the worst case scenario. For example, if there is a big crash, then will be a big return next day. This is why most of the investors fear and lose their money and miss the big opportunity. Here is the second rule, which is compounding. Everyone talk about compounding, but no one stick to long game. Here is the math which shocks everyone. Let me say you why. If we invest just 10,000 rupees for 10 years, we get 23 lakhs. Next 20 over the next 20 years, we might getting about 1 CR. But after 30 years, we might getting about 3.2 crores and 20 years return and 30 years return. So you should be stick to the long term game, not a short term gains. Stick to long term game. Second rule number two takeaway is to stick to long term game and believe in compound. Rule number three, risk is not equal to volatility. Many of you think that markets going up and down, which is risky, but the risky part is not the markets, it is in their long term game. Like market crash every 7 to 10 years, but in the 20 years period, 95% of the times the markets are in positive. So stick to the long term game and believe in compounding and believe the data. But the real risk is over leveraging and believing in short term gains. For example, if you invest uh, your short term goals in the long term instrument which gives a negative return in the short term, you may end up in the crash and getting in losses. So stick to long term, which is says cost, taxes, commissions is very dangerous. Let me say you why. They might saying that just 1% charge, 1% commission, 15% taxes, but it kills your compounding effect. Let me say you why. If we just uh, take a example, 90% of the active mutual funds have underperformed the passive funds. They are underperforming the market and getting the 1% commissions. But you might say that my fund may be in the top 10%. But let me say the numbers in math. For example, if we just 1% every year, which may erode at 25 to 50% of a capital in the 30 years long term game, which is like uh, someone in the passive fund may get 30 crore, but you may end up in 12 to 15 crores, which is very, very dangerous. So stick to passive funds, index mutual funds. If you are beginner, is behavior. Uh, Market didn't give you returns based on something, but the emotion will. If the emotion says something, then that may be wrong. Let me say you why and explain with the data. The data shows that if you fear and sell the stocks when everyone feared and buying the stocks when there is a hype, you end up in negative returns. These are very well researched company and data was very clear. You should be very happy to invest when there is a crash. Let me say you what the crash means. The crash is something, it is macro, not about the company's problem. This may be like COVID situations or the wars or something like that, which is a very, very big opportunity. It's a one decade opportunity that may not come again. And you should be very careful with the asset allocation, diversification, and consistency. And uh, don't don't think of getting the high returns. Think of like just a long term and long vision, which you can build a long big corpus. And I think you have understand these 5 rules. If you follow this, i I am pretty sure you will be a good investor, and and you will be in the top 10% in the world. And this is equity grade. Subscribe to our channel. We upload finance content, and for students, especially those who can manage their money. Thank you. Don't forget to like and subscribe.